You know, for centuries, people have tried to find some kind of order in the absolute chaos of the markets. But what if a single, repeating pattern has been hiding in plain sight all along? A pattern that predicts every major crash for the last 150 years. And what if that very same pattern is pointing its finger right at the year 2026? So let's dig in. Yeah, it's a pretty wild question, right? I mean, can a circle, a simple shape, actually predict something as massive and complex as a global financial crisis? That's the big mystery we're going to try and unpack here. This theory is a strange mix of math, history, and for some, maybe just a little bit of cosmic coincidence. And there's the year, 2026. According to the cyclical theory, that's the next big one, the next major turning point for the whole world economy. But why? What's so special about 2026? To really get the prediction, we have to get the theory first. All right, first up, what exactly is the circle? Let's get into what this mysterious theory is all about. Okay, so at its heart, the theory is pretty simple. The idea is that history doesn't just, rhyme, it literally repeats in a predictable loop. So our economy isn't just this chaotic mess. Instead, it's got this rhythm, a consistent beat of boom and bust. And if we can find that beat, maybe, just maybe, we can see what's coming next. Now, it's not just one simple idea either. It's actually got a few different flavors. You've got the financial folks who see it as a clear cycle of credit and debt just building up and then collapsing. Then you've got a more, let's say, out there interpretation, one that looks at astrological alignments and how they might affect mass psychology. And then there's a third view, which sees it all as a big geopolitical clock, tracking the rise and fall of global powers, inflation, and even war. Okay, on to our next section, history's repeating pattern. Because look, a theory is just a theory without some proof, right? So let's look at the history, the rhythm of past crises that believers are always pointing to. This idea of cycles in the economy, it's not new at all. You had guys like Clement Jaglar back in the 19th century talking about these 7 to 11-year rhythms. And then in the 20th century, Nikolai Kondratiev came up with this famous long wave theory, a 40 to 60-year cycle. But the circle theory we're digging into today, it's way, way bigger. We're talking about a massive 84 to 90-year pattern that supposedly ties together the biggest, most catastrophic crashes in modern history. So here's the evidence they put on the table. Just look at these dates: 1873, 1929, 1973, 2008. They're not just random numbers on a page. There's a pattern there. Each one is separated by a pretty consistent number of decades, fitting right into that huge cycle. And, well, if that pattern holds, the next beat in that rhythm, it's due right around, you guessed it, 2026. So, what's the engine behind all this? What keeps this circle turning? Well, according to the theory, it's us. It's human behavior, which, let's be honest, doesn't really change. We go through these 4 stages time and time again. First, there's optimism, which fuels a big boom. That boom leads to overreach, to crazy speculation. Then, boom, the correction, the crash. And after all that pain, there's a slow recovery, which builds and builds until, well, the next wave of optimism starts, and the whole thing kicks off again.
All right, section 3, this is where it gets interesting: believers versus skeptics. Because, as you can imagine, a theory this big has a lot of debate around it. Let's hear both sides.
Okay, so on one side, you have the believers. And their argument is simple. You can't ignore the pattern because you can't ignore human nature. For them, the market isn't some random number generator. It's a reflection of our collective psychology. And that psychology, our greed, our fear, it's been the same for centuries.
But then you've got the skeptics, and they fire back with a classic line from statistics: correlation does not equal causation. They say, look, our brains are literally wired to see patterns, even when there's just random noise. For them, trying to time the next big crash based on a few historical dots on a chart, that's just a fool's errand.
So really, the whole debate boils down to one massive question. Is history doomed to repeat itself because human nature is this fixed, predictable thing? Or have we finally changed the game? Have modern markets, with all their regulations and central banks, finally broken free from these ancient cycles?
Okay, section 4, the final warning signs. So putting the debate aside for a second, why are people pointing to 2026 right now? What signs are they seeing? Okay, get ready for this number: 300. trillion. That is the staggering amount of global debt out there right now. For believers in the cycle, this number is like a giant flashing red light. It's the ultimate warning sign. They see it as this massive, unstable pile of kindling just waiting for a spark. And it's not just the debt either. The proponents of this theory are pointing to a whole bunch of other things. We've got this huge AI-driven tech boom that feels a lot like the dot-com bubble, right? We have rising geopolitical tensions all over the world, and housing markets in a lot of places are stretched so thin they could snap. To a cycle theorist, these aren't just separate news stories. They're all puzzle pieces falling into place, signaling that the end of the cycle is getting close. And if a crash does happen, where would the pain be felt? Well, the theory suggests it wouldn't hit everyone equally. Tech stocks, which have been flying incredibly high, could have the furthest to fall. Housing markets could face a really nasty correction. And of course, that kind of shock would ripple out and hit emerging economies and, ultimately, ordinary households pretty hard. But hang on. What if we're asking the wrong question here? Maybe the real power of this whole theory isn't about prediction at all. Maybe its real value is about perspective. It's a powerful reminder of these cycles of excess and correction that have been with us forever. Yeah, this quote really sums it up perfectly. The circle doesn't cause the crash. It's not some mysterious force out there in the universe. It's a mirror. It just reflects our own behavior back at us, our tendency to get too optimistic, to overreach. It's just a reminder that, hey, we've done this before. And that really is the big takeaway here. Whether you're a true believer in the 2026 prediction or you think it's all just a coincidence, the real lesson is this: preparation beats prediction, every single time. Knowing the rhythms of the past, understanding the lessons about debt, speculation, and human emotion, that's our best defense for whatever is coming down the road. So as we get closer and closer to 2026, this theory really leaves us with one huge hanging question. Have we actually learned anything from all those past mistakes? Enough to finally break the circle? Or are we just doomed to repeat it all over again, just like every generation before us? I guess, in the end, the answer to that is up to us.